Most traders have experienced this. The stochastic oscillator signals overbought, only for the price to relentlessly break past your sell order, destroying your stop loss. This frustration stems from a common baseline strategy, buying when the indicator is below 20 and selling when it is above 80, that fails to account for how markets actually move during strong trends. To trade this accurately, we have to recognize the stochastic oscillator as a momentum speedometer, calculating how fast the market is moving relative to its recent range. The indicator uses two components: the fast percent K line, which measures the most recent close relative to its high-low range, and the percent D line, which is a 3-period moving average used to smooth out the data for clearer signals. Using these lines as a simple binary alarm causes traders to misinterpret sustained market strength as a sign that a reversal is mandatory. While the 80-20 rule can be effective in sideways, range-bound markets, it becomes a mechanical trap during periods of high volatility. In a powerful uptrend, the stochastic frequently stays pinned above the 80 line for days, confirming extreme, ongoing strength. Attempting to short during these high-momentum periods is the equivalent of stepping directly in front of a freight train. Profiting in these environments requires us to move past raw 80-20 readings and instead identify the specific discrepancies where price and momentum actually decouple. This decoupling is known as divergence, a scenario where the indicator's momentum begins to move in the opposite direction of the price on the chart. Regular bearish divergence occurs when the price pushes to a higher high, but the stochastic oscillator forms a lower high. This suggests that despite the new peak, the buying pressure behind that move was weaker, indicating the bulls are losing control. Conversely, regular bullish divergence shows the price hitting a lower low, while the stochastic forms a higher low, signaling that selling momentum is drying up despite the price drop. Beyond these reversals, we can use hidden divergence to identify when a trend is likely to continue rather than end. In an uptrend, if the price makes a higher low during a pullback, but the stochastic makes a lower low, it suggests the momentum has reset. This provides an entry point to join the trend before it resumes its climb. Divergence acts as a leading indicator, revealing exhaustion or hidden strength before those shifts become obvious in the price action. We can further refine our analysis by moving away from the extreme zones and focusing on the exact center of the indicator, the 50 line. The 50 line serves as a macro filter. Readings above 50 suggest bulls are in control, while below 50 indicates bearish dominance. When the fast percent K line crosses decisively above 50, it signals a shift where bullish momentum reclaims control. This crossover provides a more conservative entry trigger than trying to pick a bottom at the 20 line, as it requires the market to prove its strength before you commit capital. By treating the 50 line as the primary battleground, you filter out the false signals common in extreme zones and align your trades with the dominant market force. In professional trading, no single indicator signal is ever used as a standalone reason to enter a trade. Instead, we look for confluence, the alignment of the stochastic signals with the structural levels found on the price chart. To build a high probability setup, we start by identifying a bearish divergence. We then look to see if that divergence is occurring at a major daily resistance level that has been respected in the past. When momentum fails at a key level where sellers historically entered, reversal probability increases. The final confirmation is the price action trigger. Seeing a bearish engulfing candle form exactly at this intersection provides the signal that sellers have taken control. Combining momentum analysis with market structure and candlestick patterns allows you to identify precise windows where multiple factors confirm the same direction. You should also calibrate the indicator settings to your strategy, perhaps using a faster 533 setting for day trading or a slower 2155 setting to filter noise on daily charts. Even with a complete confluence setup, disciplined risk management and precise stop-loss placement are required to protect your account against the inevitable false signals. To practice these divergence and 50-line crossover strategies, you can open an FXNX demo account and use their backtesting tools to refine your entries in a risk-free environment. Mastering these layers of momentum analysis allows for a more sophisticated reading of market shifts that goes far beyond simple overbought and oversold levels.